Two people. Same age, same salary of $60,000 a year, same city of Denver, Colorado. Person A does what everyone tells them. Saves after paying bills, invests when they feel comfortable, buys a house because it's the American dream. Person B applies basic mathematics I learned in college. 30 years later, Person A has maybe $300,000 saved and a paid-off house. Person B has $4.7 million in liquid assets. Same starting point. Wildly different math. I'm James Simons. I'm 86 years old. I'm worth $28 billion, and I'm going to show you exactly what Person B did, step by step. And it's so simple you'll be angry no one told you sooner. For 3 decades, I ran Renaissance Technologies with an average return of 39% per year, while the so-called experts barely hit 10. The difference? They guessed based on feelings and news headlines. I calculated based on probability and patterns. And the mathematics I used to build billions? You already learned it in 9th grade. You just never saw how it applies to your actual life. Today I'm going to prove, with numbers that don't lie, that you don't need to be smart or lucky or rich to become a millionaire. You need $1,000 a month and the discipline to not touch it for 30 years. That's it. The math is bulletproof. The execution is where 97% of people fail. Here's what most people don't understand. Wealth has nothing to do with how hard you work. I know that sounds insane coming from someone worth $28 billion, but it's mathematically true. Wealth is a function of time, multiplied by return, multiplied by consistency. Work ethic doesn't appear in that equation. I've met people working 80 hours a week who die broke. I've met people working 30 hours a week who retire with $5 million. The difference isn't effort. It's understanding exponential mathematics versus linear thinking. Let me show you the exact moment this clicked for me. I was 30 years old, teaching mathematics at MIT, making $35,000 a year. Barely scraping by. I looked at my colleagues in their 60s who'd worked their entire lives and had maybe $200,000 saved. I did the math on their savings rate and realized they were thinking linearly. Save $5,000 a year for 40 years equals $200,000. They were right, but they were also broke. Then I calculated what happens if you invest $5,000 a year at a 10% return for 40 years. The answer? $2.2 million. Same effort, same $5,000 per year. But one approach uses exponential growth, and the other doesn't. That realization changed my life completely. Most people hear about compound interest and nod politely, then do absolutely nothing with the information. It's like learning that exercise prevents heart disease and then eating fast food every day. You know the truth, you just don't believe it applies to you. So let me prove it applies to you with a calculation so clear there's no room for doubt. Start with $0 today. Invest $1,000 per month. Use the historical stock market average return of 10% per year. Let's calculate what happens year by year. Year 1. You invest $12,000. With 10% return, you end the year with approximately $12,600. Your money made $600 while you slept. Year 2. You invest another $12,000. You now have $25,800 invested, which grows to $28,380. Your money made $2,580 this year. Year 3. Invest another $12,000. Total invested is $37,800. Grows to $44,818. Your money made $7,018. See what's happening? The amount your money makes each year keeps growing even though you're putting in the same $1,000 per month. By year 10, you've invested $120,000, but you have $204,504. Your money made $84,504. You made $84,000 doing absolutely nothing except not touching your investments. By year 20, you've invested $240,000 and you have $763,709. Your money made $523,709. You personally put in $240,000. Mathematics gave you an extra $500,000. By year 30, you've invested $360,000 total, and you have $2.2 million. Your money made $1.84 million. You contributed $360,000. Exponential growth contributed $1.84 million. That's 5 times more than you put in. This isn't a trick. This isn't a scam. This is just compound interest doing what compound interest mathematically must do given enough time. If you want to understand how to think in patterns instead of guesses, if you want to see why most financial advice is designed to keep you broke while sounding smart, subscribe right now. I spent 30 years proving that mathematics beats intuition every single time in markets. Today, I'm showing you how to apply that same mathematical thinking to your personal wealth. Most people prefer exciting stories about getting rich quick. You prefer boring math that actually works? Hit subscribe. Now, here's where it gets interesting and where most people's brains break. The majority of that $2.2 million gets created in the last 10 years. Let me show you the numbers. After 20 years of investing $1,000 per month, you have $763,000. After 30 years, you have $2.2 million. That means in the final 10 years alone, your wealth grew by $1.4 million. In the first 20 years, it grew by $763,000. In the last 10 years, it grew by almost double that amount. Why? Because exponential growth accelerates over time. The larger the base, the faster it grows. This is why starting early is so powerful, and why waiting is so expensive. Every year you delay starting costs you approximately 3 years of growth on the back end. If you start at 25, you hit $2.2 million at 55. If you start at 35, you hit that same number at 65. 10-year delay costs you 10 years of your retirement. But it's actually worse than that, because those last 10 years are when the exponential curve goes vertical. If you delay 10 years, you don't just lose 10 years of time, you lose the most powerful years of compounding. Let me tell you how I took this principle and turned it into Renaissance technologies. I wasn't trying to build a hedge fund. I was trying to solve a mathematical problem. Can market behavior be predicted using statistical models? Everyone said no. Markets are random, efficient, impossible to predict consistently. I thought that was probably wrong. Not because I had a hunch, but because I'd worked on code breaking during the Cold War. I knew that what looks like random noise often contains hidden patterns if you have the right tools to detect them. So, in 1982, I founded Renaissance with a simple hypothesis. If we analyze enough market data with sophisticated mathematical models, we should find statistical edges. Not guarantees, not certainties, just slight probabilistic advantages that over thousands of trades become reliable. We started testing. Built algorithms that scanned for patterns in price movements, trading volumes, correlations between assets. Hired physicists and mathematicians who knew nothing about finance, but everything about signal processing and statistical analysis. We weren't trying to understand why markets moved. We were trying to find patterns in how they moved. The breakthrough came when we stopped thinking like investors and started thinking like scientists. Investors ask, Why will this stock go up? Scientists ask, what does the data say about probability distributions of price movements given these conditions? Completely different questions, completely different results. By the late 80s, we'd refined the medallion fund strategy to the point where we had genuine mathematical edges. Small edges, 1 or 2% per trade on average, but edges nonetheless. And when you make 10,000 trades per year, with a 1% edge on each, the law of large numbers kicks in. Over 10 trades, randomness dominates. Over 10,000 trades, probability dominates. We weren't smarter than everyone else. We just understood that mathematics doesn't care about individual outcomes. It cares about aggregate probabilities over large sample sizes. The result was 30 years of never losing money. Not because we never made bad trades. We made thousands of bad trades. But we made more good trades than bad trades. And the mathematics of that slight edge, compounded over 30 years, created returns that seemed impossible. 39% annually, every year, for 3 decades. Starting with $100,000 in the Medallion Fund in 1988, you'd have over $300 million by 2018. The S&P 500 would have turned that same $100,000 into $2.3 million. Both impressive. One is 130 times better. That's the power of a mathematical edge executed consistently over time. Now let me show you 4 ways to apply this exponential thinking to your own life, starting right now with whatever money you currently have. These applications work whether you're making $40,000 a year or $200,000 a year. The numbers scale, but the mathematics stays the same. Application number 1. Why your intuition about money is statistically designed to make you broke. This is going to hurt, but it's mathematically provable. Human brains evolved to think linearly and react to immediate threats. We're good at, if I see a lion, I should run. We're terrible at, if I invest consistently for 30 years, I'll have millions. The threat is visible and immediate. The reward is invisible and decades away. This creates a psychological trap. Your brain wants you to spend money now on things you can see and touch. It doesn't want you to invest in abstract future wealth you can't perceive. This isn't a character flaw, it's evolution. Our ancestors who saved resources for 30 years in the future died when the immediate lion ate them. Our ancestors who handled immediate threats survived and passed on their genes. You inherited a brain optimized for short-term survival, not long-term wealth building. Here's the mathematical cost of this evolutionary mismatch. The average American makes approximately $55,000 per year. The average American retires with less than $300,000 in savings. Let's do the math on what should have happened versus what actually happened. If that average American had invested just 10% of their income starting at age 25, that's $5,500 per year, or about $458 per month. Over 40 years at 10% return, that becomes $2.4 million. They would have invested $220,000 total. The market would have generated $2.2 million in growth. Instead, they have $300,000. They left $2.1 million on the table because their brain told them to buy things now instead of invest for later. $2.1 million is the cost of following your intuition instead of following mathematics. Your intuition says, I'll invest when I make more money, when I feel more secure, when the market looks safer. Mathematics says, every month you wait costs you compound growth you can never get back. Let me show you a concrete example. 2 sisters, both living in Chicago. Both make $70,000 a year working similar jobs. Sister A listens to her intuition. She thinks, I'll start investing seriously once I pay off my car, once I save an emergency fund, once I feel more financially stable. She's 30 years old. She waits 5 years to start investing. At 35, she finally starts putting $1,000 per month into index funds. Sister B ignores her intuition and follows the math. At 30, she immediately starts investing $1,000 per month, even though it feels uncomfortable, even though she has some debt, even though the market seems scary. Both invest $1,000 per month at 10% for 30 years. Sister A starts at 35, invests until 65. She puts in $360,000 over 30 years and ends with $2.2 million. Sister B starts at 30, invests until 60. She puts in $360,000 over 30 years and ends with $3.9 million. Same monthly investment. Same rate of return. Sister B has $1.7 million more just because she started 5 years earlier. That 5-year head start is worth $1.7 million. Why? Because those first 5 years grow for an extra 30 years, and exponential growth in the final decades is massive. Sister A's last dollar invested only grows for 1 year. Sister B's first dollars grow for 35 years. This is what I mean when I say your intuition is expensive. Waiting until you feel ready costs you millions. Waiting until the market feels safe costs you millions. Waiting until you have more money costs you millions. The mathematics says, start now with whatever you have, even if it's uncomfortable, even if it feels too early, even if the amount seems small. Application number 2. Why buying a house might be the worst financial decision you ever make. I know that sounds insane. Everyone says, buy a house, build equity, own something real. But let's actually run the numbers instead of repeating conventional wisdom. Take someone in Austin, Texas, looking at a $500,000 house. They put down 20%, so $100,000 down payment. They mortgage $400,000 at 7% interest for 30 years. Their monthly payment is approximately $2,657. Over 30 years, they'll pay approximately $956,000 total for that $400,000 loan. Add back the $100,000 down payment, and the total cost is $1.056 million for a house that might be worth $800,000 in 30 years if they're lucky, and Austin keeps growing. Now, let's compare to the alternative. Instead of buying, they rent a comparable place for $2,000 per month. That's $657 per month less than the mortgage payment. They invest that $657 per month at 10% for 30 years. They also invest the $100,000 down payment they didn't spend. Let's calculate. $100,000 invested at 10% for 30 years becomes $1.745 million, plus $657 per month for 30 years at 10% becomes $1.4 million. Total, $3.145 million. Option A, own a house worth $800,000. Option B, have $3.1 million in investments that generate approximately $125,000 per year in passive income at 4% withdrawal rate. Option A leaves you house rich and cash poor. Option B leaves you wealthy and flexible. You can live anywhere, move anytime, and have more income than most Americans earn from working. But everyone chooses option A because owning property feels safe and real, while owning index funds feels abstract and risky. Feelings don't compound. Math does. Now I can already hear the objections. What about tax deductions on mortgage interest? Factor it in, the math still favors investing. What about rent increases? Factor them in, still favors investing. What if the house appreciates more than expected? Possible, but historically, houses appreciate at about 3%, while stocks appreciate at 10%. What about the pride of ownership? That's an emotional argument, not a mathematical one. I'm not saying never buy a house. I'm saying run the actual numbers first instead of assuming it's always the right move. For most people under 40, making less than $100,000 per year, renting and investing, the difference creates more wealth than buying. But nobody tells you this because real estate agents, mortgage lenders, and the entire housing industry profit from you buying. Following that advice makes them rich. Running your own math makes you rich. Quick curiosity of mine. I want to map where the people who actually calculate instead of just following conventional wisdom are located. Where are you watching from? Drop your city and state in the comments, or your country if you're outside the US. I'm genuinely curious whether mathematical thinkers cluster geographically or if you're evenly distributed. Let's create a map of people who run the numbers before making major life decisions. Drop your location below. Application number 3. Why maxing out your 401k might be costing you flexibility and wealth. Another sacred cow everyone accepts without questioning. The advice is always, max out your 401k, get the employer match, take advantage of tax benefits. Sounds smart, but let's examine what you're actually doing. A 401k locks your money away until age 59 and a half. Early withdrawal means 10% penalty plus income taxes. So you're trading access to your money for 40 years in exchange for tax deferral. For many people, that trade isn't optimal. Here's why. Let's say you're 30 years old making $80,000 a year. You max out your 401k contribution at $23,000 per year. That money grows tax-deferred, and you save approximately 30% on taxes now. Sounds great. But in 30 years when you retire, you have to pay ordinary income tax on withdrawals, which could be 25 to 40%, depending on your tax bracket. You delayed taxes for 30 years and might pay the same rate or higher later. Alternative strategy. Contribute enough to get your employer match. That's free money, so obviously take it. Let's say that's 6% or $4,800 per year. The remaining $18,200 you invest in a taxable brokerage account in index funds. You pay taxes on contributions now, but all growth is taxed at long-term capital gains rates, which are 0, 15, or 20%. Much lower than ordinary income rates. Plus, you have complete access to this money anytime with no penalties. Need it for an emergency? Accessible. Want to retire early? Accessible. Want to start a business? Accessible. Your 401k money is locked up and inaccessible without penalties. Let's run the numbers. 401k approach, $23,000 per year for 30 years at 10% becomes $4.2 million. Withdraw at 25% average tax rate leaves you $3.15 million. Taxable account approach. Contribute $18,200 per year for 30 years at 10% becomes $3.3 million. Pay 15% capital gains on the $2.5 million of growth. That's $375,000 in taxes. Leaves you $2.925 million after taxes. Plus, you contributed $4,800 per year to 401k for the match, which becomes $875,000 after tax, total of $3.8 million. The taxable account approach leaves you with $700,000 more and complete flexibility for 30 years. Why? Because capital gains rates are lower than ordinary income rates, and accessibility has value. But everyone maxes their 401k because that's what all the financial advisors say. Who benefits from that advice? The financial industry that manages 401k plans and charges fees for 30 years. Who potentially loses? You, by locking up money you might need and paying higher tax rates later. Again, I'm not saying never use a 401k. I'm saying run your specific numbers with your specific tax situation instead of blindly following generic advice. Application number 4. Why trying to time the market costs you more than every market crash in history combined? This is the mistake I see brilliant people make over and over. They wait for the right time to invest. Market's too high, I'll wait for a dip. There's a recession coming, I'll wait it out. Politics are uncertain, I'll wait for clarity. They're trying to be smart. They're actually being statistically stupid. Here's the data. From 1928 to 2023, 95 years, the S&P 500 averaged 10% annual returns. During that time there were the Great Depression, World War II, multiple recessions, the dot-com crash, 9/11, the 2008 financial crisis, COVID-19. Markets crashed repeatedly. And still, if you invested consistently through all of it, you averaged 10% per year. Now, let's look at people who tried to time the market by avoiding the crashes. Studies show the average market timer underperforms buy-and-hold investors by approximately 3 to 4% annually. Why? Because they miss the recovery days. The market's biggest up days usually happen right after the biggest down days. If you sell during a crash to avoid losses, you miss the snapback rally. Missing just the 10 best days in the market over 30 years reduces your returns by approximately 50%. You're trying to avoid the bad days, but you end up missing the best days. And the math of missing the best days is devastating. Let me show you concrete numbers. Person A invests $1,000 per month for 30 years and stays invested through everything. Never sells during crashes. Never tries to time entries. Just mechanical monthly investments. They end with $2.2 million, as we calculated. Person B does the same thing but tries to time the market. During market downturns, they stop investing and move to cash to avoid losses. They miss approximately 6 months of investing during crashes over 30 years. They also miss the recovery rallies because they're waiting for confirmation the bottom is in. Let's say their timing costs them just 2% per year in returns. Instead of 10%, they average 8%. Same $1,000 per month for 30 years at 8%, instead of 10%, becomes $1.49 million. They cost themselves $710,000 by being clever. Person A did nothing except not panic. Person B tried to be smart and lost $710,000. The mathematics clearly states, time in the market beats timing the market. But people's brains can't accept this because it feels wrong to invest when everything looks bad. Your feelings lose to math every time. Here's the scientific pattern across all 4 applications. Your intuition about money is systematically wrong because evolution didn't prepare you for exponential thinking or delayed gratification. The solution isn't to try harder or be smarter. The solution is to automate decisions so your brain doesn't interfere. Set up automatic monthly investments. Don't check your account daily. Don't read financial news. Just let the mathematics do what it mathematically must do over time. I ran Renaissance Technologies for 30 years with this exact principle. Remove human emotion. Follow the probability. Execute consistently. The result was 39% annual returns because mathematics doesn't panic, doesn't get greedy, doesn't have feelings. It just compounds. Now, let me show you the final proof that ties everything together. We've covered 4 applications of exponential thinking. Let's now see what happens when someone applies all 4 simultaneously versus someone who follows conventional wisdom. Person A follows conventional wisdom. Starts investing at 35 after they feel stable, buys a $500,000 house with a 30-year mortgage, maxes out 401k for tax benefits, tries to time market entries during volatile periods. They work hard, follow all the standard advice, and retire at 65. After 30 years they have a paid-off house worth approximately $800,000, 401k worth approximately $2 million after taxes, total net worth of $2.8 million. Not bad. Better than most Americans. Person B follows mathematical optimization. Starts investing at 25, even though it's uncomfortable. Rents and invests the difference. Balances 401k with taxable accounts for flexibility. Invests consistently regardless of market conditions. Same income level. Same cities. Similar jobs. After 40 years, Person B has approximately $6.5 million in liquid investments that generate $260,000 per year in passive income at 4% withdrawal rate. Person A has $2.8 million mostly locked in a house. Person B has $6.5 million in flexible investments. Person B has 2.3 times more wealth from the same income simply by thinking exponentially instead of linearly. Here's the reality check most people need to hear. Statistically, 97% of people who watch this won't change anything. They'll nod along, think it's interesting, and then continue doing exactly what they were doing before. Not because they're stupid, because changing behavior is hard, and thinking long-term is uncomfortable. The other 3% will actually calculate their own numbers, set up automatic investments, and let mathematics compound for decades. Those 3% will become millionaires almost automatically. The 97% will work until they're 70 and wonder why they're still broke. Which group you're in isn't about intelligence. It's about whether you trust mathematics more than you trust your feelings. So if the math I showed you makes logical sense, if you can see why exponential growth beats linear effort, hit the like button right now. Statistically, only 3 to 5% of YouTube viewers actually like videos, even when they find them valuable. Be part of the minority that acts on logic instead of inertia. Subscribe if you haven't yet, because I'm going to keep breaking down financial mathematics that schools never taught you, and the financial industry doesn't want you to understand. And comment below with your city and state. I want to test a hypothesis. Do people who think mathematically cluster in certain regions, or are they uniformly distributed? Let's collect the data. Drop your location below, and let's see what pattern emerges. Remember, you don't need to be smart or lucky to build wealth. You just need to not be stupid consistently for 30 years. The math handles the rest.